Hello everyone, and thank you for joining today's True Trading webinar. I'm excited to be here with you. My name is Mohammed Azim from Traders United. First, there is disclaimer. House rules. Please take the time to read important webinar attendee rules. Let me start by sharing a little information about myself. I'm a certified elite wave analyst, having earned my level 1 certification back in the year 2012 with a score of 93%. This certification deepened my understanding of market behavior, especially through the lens of elite wave theory. In addition to my work as an analyst, I'm also an author and educator. I wrote Introduction to Elite Wave Theory, a book designed to help traders like you build a strong foundation in understanding the intricate structure of market waves. But my expertise does not stop at Elite Wave. Over the years, I have expanded my knowledge into broader market analysis, diving deep into market trends, chart patterns, and price action strategies. So, whether you are a beginner or an experienced trader, I aim to provide you with valuable insights that will help you navigate and succeed in the Forex markets. With that, let's dive into today's session. These are the session goals. Let me talk about macroeconomic events and data releases. I am going to cover previous week fundamental analysis. The first one is the official bank rate, United Kingdom, and I'm going to discuss the GBPUSD currency pair. Next one is the unemployment rate related to Canada, and I'm going to discuss the US dollar versus Canadian dollar currency pair. Let's start with the first one, official bank rate, United Kingdom. What is the official bank rate? The official bank rate set by Bank of England is the benchmark interest rate that influences borrowing costs across the UK economy. It determines how much commercial banks pay to borrow from the central bank and directly affects mortgages, business loans, and savings rates. A rate hike generally strengthens the British pound as higher interest rates attract foreign investment and reflect tighter monetary policy. Conversely, an interest rate cut tends to weaken the British pound, signaling easier policy and slower economic momentum. For forex traders, the bank rate is a major driver of GBP/USD currency pair, shaping expectations around growth, inflation, and the Bank of England's future policy stance. Now, the previous number got was 4%, forecast was 4%, and the actual number we got on November 6th is also 4%, so no change. As expected, the Bank of England kept the bank rate unchanged at 4%, marking another pause as policymakers balance persistent inflation pressures against slower economic growth. Ahead of the decision, the British pound traded cautiously, but following the release and accompanying statement, GBPUSD moved higher, reflecting a slightly hawkish tone in the Bank of England's communication and market confidence in the UK's economic outlook. The UK economy continues to face a mixed backdrop. Inflation remains above target while growth has softened. The Bank of England reaffirmed its commitment to controlling inflation, emphasizing that rates will stay restrictive for a long period of time, as long as is necessary. This data dependent but cautiously hawkish stance boosted investor sentiment towards the British pound. With no hint of imminent interest rate cuts, Forex trader translated the decision as a sign of policy stability, helping GBPUSD climb modestly above the announcement. Let me show you the chart of GBPUSD currency pair. So over here, if I zoom out a little bit, this is the daily time frame of GBPUSD currency pair. So we got this news announcement on November 6th and market rallied up over here. So price action actually moved up, okay, in GBPUSD currency pair. Now the interest rate did not get raised, okay. What I mean by that is we got the 4% number. So Bank of England just simply hold the interest rate, and that was basically the expectation or the forecast as well. But the tone leaned hawkish, which pushed the GBPUSD currency pair higher. The Bank of England's language suggested confidence in inflation progress while maintaining vigilance, a balance that supported the British pound. So the overall analysis and the key takeaway is the meeting underscored the Bank of England's delicate balancing act, keeping interest rate high enough to curb inflation while avoiding excessive strain on economic growth. With inflation easing but still above target, the Bank of England's decision to hold steady at 4% combined with its measured tone reassured forex markets that no premature rate cuts are on the horizon. That reassurance translated into GBPUSD strength post announcement. So the forecast was 4%, and the number we also got is the same 4% number. Okay, so volatility actually spiked after the news announcement, but sentiment quickly turned positive for the British pound. Traders should continue monitoring upcoming inflation and employment data for signs of whether the Bank of England may maintain or ease its stance in early 2026 year. So the Bank of England's steady hand and firm message on inflation supported the GBP, driving GBPUSD currency pair higher as forex traders priced in a prolonged period of restrictive policy before any future rate cuts. The next one is the unemployment rate related to Canada. So what is the unemployment rate? The unemployment rate measures the percentage of Canada's labor force that is without work but actively seeking employment. It is a vital indicator of overall economic strength, household spending capacity, and business confidence. A rising unemployment rate typically signals a slowing economy and weaker labor conditions, putting downward pressure on the Canadian dollar as it raises expectations for monetary easing by the Bank of Canada. Conversely, a decline in unemployment indicates stronger job creation and economic resilience, which generally supports the CAD by reducing the likelihood of near term rate cuts. For Forex traders, this report is, I would say, a key driver for USD-CAD principle, as labor market trends heavily influence the Bank of Canada's policy outlook and the perceived strength of Canada's economy relative to the USA. So the previous number was 7.1% number, the forecast was also 7.1%, and the actual number we got is 6.9%. So attention turned to Canada's latest employment figures released at 1:30 p.m. UTC time on November 7th. The unemployment rate fell to 6.9%, better than the forecast and previous 7.1%. This improvement signaled renewed labor market strength despite high borrowing costs and slower growth elsewhere in the economy. Following the release, USD CAD moved sharply lower. Let me show you the chart of USD CAD. So over here, we got the data news release on November 7th, and USD CAD simply dropped. I do expect further weakness in price action, but first market is going to move sideways. So the drop in Canada's unemployment rate came as a pleasant surprise for forex markets. The data showed that hiring momentum remains intact, suggesting that the economy is withstanding restrictive monetary policy better than expected. This stronger labor print reduced speculation of near-term Bank of Canada's easing, prompting broad CAD buying. As a result, USD CAD declined, extending losses as traders priced in a more stable economic outlook for Canada. So the unemployment rate we got is 6.9%. That's the actual outcome we got, which means a stronger labor report supports the CAD by showing economic resilience and reducing the odds of rate cuts. And the market reaction we got is that the USD CAD moved down, reflecting the uh, Canadian dollar strength. This report reinforces the view that Canada's labor market remains resilient despite tighter financial conditions. The better than expected result at 6.9% suggests steady hiring and improving confidence, giving the Bank of Canada more room to hold rates steady in the near term. The market response was immediate. USD CAD moved lower, confirming trader optimism towards the CAD and a more balanced outlook for the Canadian economy heading into the year 2026. So expected continued volatility, the market continued volatility as forex traders reassesses Bank of Canada's policy expectations. If upcoming inflation and wage data confirm this strength, USD CAD could remain under pressure with buyers cautious until signs of economic slowdown re-emerge. So the key takeaway is a stronger than expected jobs report, meaning we got a less unemployment number that's good for the Canadian economy. And it, this number boosted the Canadian dollar, sending the USD CAD lower. The result underscores the resilience of Canada's labor market and reinforces the view that the Bank of Canada may keep interest rates higher for longer, supporting CAD momentum in the near term. Now, let us take a look at previous week global market trends. Let's talk about the euro dollar, and then I'm also going to take a look at US dollar Swiss franc currency pair. So, this is the chart of euro USD currency pair. It seems to me price action is trying to rise up over here. Last week we got this key reversal candlestick, and if you take a look at a daily time frame, I was expecting a drop in the market at or around the support level. So somewhere around this area, market actually rallied up. Now it's still in a danger zone, meaning I would say the trend is still bearish, especially if we try to draw a trend line like this. This is still a downtrend going on. Let me remove this trend line and also remove this one as well. So if market really wants to rise up, then we should get a bullish breakout above this trend line. If it happens, then obviously the chances are high that Euro USD is going to rise up even further. Next one is the US dollar Swiss franc. Swiss franc showed us this breakout, but failed to stay higher. Also, it didn't go above this old swing high. Let's take a look at the daily. So over here, this is what I was expecting. I was expecting a bullish rally in US dollar Swiss franc. This is what we got exactly. And now the US dollar Swiss franc is just trying to drop over here. So this thing is telling me that USD Swiss franc is probably going to drop more in coming trading days. So my forecast is bearish for the US dollar versus Swiss franc currency pair. Okay. Next, let us take a look at current week's macroeconomic events and data releases. I will be covering the key developments in Forex market with the focus on fundamental analysis. Okay. So the first one is the AUD USD. Unemployment rate Australia. What is the unemployment rate? Let's discuss it a little bit. The unemployment rate measures the percentage of Australians who are without work but actively seeking employment. It is a key gauge of economic and labor market health, showing how strong or weak the labor market is and how it may influence monetary policy by the Reserve Bank of Australia. A higher unemployment rate signals slower growth and may put downward pressure on the Australian dollar as it increases the likelihood of future Reserve Bank of Australia rate cut. Conversely, a lower unemployment rate points to stronger job creation and confidence, often supporting the Australian dollar against the US dollar. So let's take a look further. We are expecting unemployment rate on November 13 at 12:30 a.m. UTC time. The previous number we got was 4.5%. The forecast is 4.4%. The actual data not yet released. So the pair in focus is the Aussie dollar currency pair, AUD USD currency pair. So all eyes are on Australia's unemployment rate coming out tonight at coming out at 12:30 a.m. UTC time on November 13th. Markets are expecting a small improvement to 4.4%, down from the previous 4.5%. Forex traders and investors will be closely watching to see if the labor market shows signs of resilience or if there are hints of slowing momentum. The release could influence short term moves in AUD USD as the labor market is one of the Reserve Bank of Australia's main considerations when deciding on monetary policy. The Australian labor market has remained relatively strong, but recent reports show some moderation in hiring due to higher borrowing costs and global economic uncertainty. Let me show you the chart of AUD USD currency pair. Here's the weekly chart of AUD USD currency pair, and the downtrend is clearly visible. If you look at a daily chart, this is where we got the gap, market rallied up, then we got a retest. Now it's trying to rise back up over here. It looks kind of a sideways market, I would say. Okay, so this retest over here of this trend line, it looks quite visible. Okay, if the unemployment rate comes in lower than expected, it would indicate that the labor market is stronger than anticipated. This could boost the Australian dollar, as forex traders may interpret it as reducing the chance of rate cuts by the RBA. If the reading matches the expectations, like we get a 4.4% number, the forex market may react modestly, seeing the labor market as stable but not overly robust. Conversely, if the rate rises above 4.5%, it would signal a cooling labor market, potentially weakening the Australian dollar against the United States dollar, as expectations for Reserve Bank of Australia easing increase. Now, let me discuss potential market scenario. Let's say we get a number which is less than 4.3% number, then it means stronger labor market, and AUD USD currency pair is probably going to rise up more, and traders may buy the AUD USD, pushing the pair higher. And let's say we get a 4.4% number which matches the forecast, then expect a muted reaction in market is probably going to move sideways. And the last option is, let's say we get a number which is higher than 4.5%, then that's bearish for the Australian dollar, and AUD USD currency pair is probably going to drop. Well, the trend is already down. If you take a look at this daily time frame over here, or it's kind of a bit sideways over here, I would say this was the support. Let me draw the trend line over here. So this was the support. Price action kind of bounced back up from the support over here. So the trend, as far as the chart is concerned, looks a bit sideways. So if we get uh, a 4.5% number, then obviously, or a number that is greater than 4.5%, then obviously that would be bearish, and AUD USD is probably going to drop more. So the unemployment rate is a critical barometer for Australia's economic health and the RBA's future policy direction. A stronger than expected reading would reinforce confidence in the labor market and could support the AUD, while a weaker reading might fuel speculation of future rate cuts, pressuring AUD USD. Forex traders should focus not just on the headline number but also on any commentary regarding employment trends, participation rates, and wage growth for clues on how the Reserve Bank of Australia may respond in the coming trading months. So the trading outlook is expect increased volatility around the news release. Traders should watch how the Australian dollar reacts in the first few minutes, as initial moves can be sharp. A stronger report could trigger a rapid AUD USD spike, while a weaker number may result in quick downside pressure. The unemployment rate remains one of the most closely watched indicators for the AUD. Even a small surprise can shift short term sentiment and influence the Reserve Bank of Australia's rate outlook, making this release essential for forex traders of AUD USD currency pair. The next one is the manufacturing sales. M over M means month over month related to Canada, and we're going to discuss the US dollar versus Canadian dollar currency pair. Now, let's talk about it. What is the manufacturing sales? The manufacturing sales report measures the month to month change in the total value of sales by Canadian manufacturers. It is an important gauge of industrial activity and overall economic momentum. Stronger than expected sales indicate rising demand and business confidence, which typically support the Canadian dollar. Conversely, weaker sales suggest slowing production and softer economic conditions, often putting downward pressure on the CAD against the United States dollar. Now, the date is November 14th and the time is 1:30 p.m. UTC time. The previous number we got was minus 1.0%. The forecast is 2.6%. The actual data not yet released, but it is going to be released on November 14th. And the currency pair we are going to focus is the US dollar versus Canadian dollar currency pair. Up next, the spotlight is on Canada's manufacturing sales report scheduled for 1:30 p.m. UTC time. The market is looking for a rebound this month with forecasts at 2.6% following a decline of 1.0%. That is in negative territory. So minus 1.0, that was the previous number. Forex traders will be closely watching this data as it provides insight into the health of Canada's manufacturing sector and broader economic conditions, both of which can influence the Bank of Canada's near term policy outlook. Canada's manufacturing sector has faced headwinds from higher borrowing costs and softer global demand, but recent indicators hint at possible stabilization. If the Canada's manufacturing sales figure beats expectations, it would signal stronger business activity, likely boosting the CAD and putting downward pressure on the US dollar versus Canadian dollar currency pair. Let me show you the chart of USD CAD. Here's the chart of US dollar versus Canadian dollar currency pair. Right now, the USD CAD is actually going down over here. So if the report comes in line with forecast, the market may see only a muted reaction and probably go sideways, keeping USD CAD range bound. However, the way I see, we got this nice uptrend channel over here, and market is now trying to drop over here. Price action is probably going to hit this lower upward sloping trend channel line. So the possible scenario is that let's say we get a number which is let's say 2.6% number that signals robust industrial demand, and this means bullish CAD. So the likely reaction is USD CAD. This consumer moves lower. Well, it's already going down over here in a daily time frame. Now, if the price, shows some sort of a sideways price action, like sometimes market doesn't, just go in a straight line. So it's possible that price action is probably going to rise up first, create a short-term bullish pullback, and then market is going to drop. Another scenario is the forecast we get is 2.6%, then obviously market is going to move sideways. And the last scenario is if the number we get is less than 2.6% number, then that's weaker than expected number. The CAD would become bearish and the USD CAD may rise as market price and weaker economic momentum. This report provides a clear snapshot of Canada's industrial health. A stronger print can reinforce confidence in the Canadian economy, supporting the CAD, while disappointing numbers may raise concerns about slower growth and boost US dollar versus Canadian dollar currency pair. Forex traders should also monitor any commentary accompanying the financial report, as it can provide clues about future Bank of Canada policy decisions. So the trading outlook is expect short-term volatility around the news release at 1:30 p.m. UTC time on November 14th. Early forex market reactions can be sharp, especially if the data surprises. Forex traders should watch both the headline figure and any details or sectoral performance for clues on the Canadian economic trajectory. Canada's manufacturing sales is a crucial indicator of economic momentum. Even a small surprise can influence US dollar versus Canadian dollar, making this one of the key events for Canadian dollar traders this week. The next one is the global market trends. Let's talk about the euro dollar and then AUD USD currency pair. The first one is the euro dollar, and we got this breakdown over here, but price action is still holding above 1.1390 level. And if you take a look at the daily time frame looks bearish. However, the 4 hour is actually kind of trying to rise up over here. If I zoom out a little bit, so it's quite possible that market is probably going to drop first in euro dollar currency pair and then expect further upside in euro USD. So a good idea is to wait for a pullback first in euro dollar currency pair. Okay, if market really wants to go up, wait for a pullback, and once market rise back up, then look for a potential buy trade setup. Next one is the AUD USD currency pair. The trend is clearly down, as shown by this downward sloping trend line in a weekly chart. If you take a look at this daily, the daily time frame looks a bit sideways. 4 hour time frame, let's see what's going on. 4 hour is also a bit sideways. It first market rallied up, then we got the drop in the market, and now market is again trying to rise back up again. So the direction looks a bit unclear, I would say. In AUD USD currency pair, it's better to stay on the sidelines or wait for the market to break the support level first. If it breaks it, then a good idea is to look for potential sell trade setups. Next one is the US dollar versus Canadian dollar currency pair. So US dollar CAD, the way I see market is probably going to show a bullish pullback first, and sometimes we even get a deeper pullback, something like this, and then the chances are that price action is going to drop further. Next one is the spot gold. Let's take a look at spot gold. Spot gold, we got kind of a big drop in the market, and then Spot gold is trying to rise back up over here. If you take a look at this daily time frame, market is, I think this looks like to me we got um, kind of a pullback over here, and price action is probably going to retest this trend line first. So the way I see, the gold is probably going to rise up first. Okay, let me change the color of this trend line. So the way I see, spot gold is probably going to rise up in coming trading days. Looks uh, sideways and overall bullish. If you have any questions or comments, feel free to type inside the chat box and I will be happy to answer your questions. So what we have learned today? Well, we discussed about the unemployment rate related to Australia, and we also discussed about manufacturing sales related to Canada. Then I also discussed about euro dollar, AUD USD, USD CAD, and spot gold. These are the assets to watch out for profits. What you should do next, stay tuned for the schedule of next week's trading webinar. Subscribe to our social media pages to stay updated with true exciting events, trading content, and market insights. And if you want to learn more about trading, visit TradeGeek and access free trading courses for beginner, intermediate, and expert traders. Thank you for hanging around. See you at the next trading webinar on Tuesday, November 18th at 2025, 12 p.m. UTC time. So that's it for the timing from my side. Have a nice day and bye bye.